Hello again, it's Trevor at Heritage Reverse Mortgage, Southern Utah's reverse mortgage specialist. My article today talks about the myth around ownership of a home when somebody does a reverse mortgage. There is a myth that's out there that says that when you do a reverse mortgage, the bank owns your home, the bank gets to keep your home when you pass away. And this is absolutely not true. However, the myth has been born of circumstances that are in fact, point towards that being a reality. And so I understand how this myth was created. And let me clarify it for you so that you understand truly what happens with a reverse mortgage. In the old days, when people did reverse mortgages, the terms allowed people to borrow high percentages of their home equity up front. This, combined with higher interest rates, made it almost a sure thing that most reverse mortgages would eventually go upside down, meaning that the mortgage balance would be higher than the home was actually worth when the homeowner passed away. In these situations, the family is left with a couple of options. One, they can still step in and buy the home. They only have to pay 95% of what the home is actually worth at that point, and FHA is going to cover the other losses. The other option is that the family would just walk away. And this is usually what happens. Consider the kids already have their own lives. Their kids are in different schools in different cities. When mom and dad pass away, they don't want to uproot everything to move to a new city. And so, in most of these situations, what has happened is the kids just say, "We don't care. You can have it." In that case, the bank will take the home, foreclose on it, and then they resell it to get whatever value they can to help repay back the mortgage that the parents had. Now, as I mentioned, over the past 5 years, reverse mortgages have gone through a major facelift. And so, what I call the new reverse mortgage is totally different versus the old reverse mortgage of about 5+ years back. And so, under the new reverse mortgage terms, the FHA has stepped in, they've reduced loan amounts, they've reduced interest rates, they've reduced the cost of a reverse mortgage. And so the difference now is that for most borrowers that do a reverse mortgage today, their home will never run out of equity. Unless the market goes through another major 50% market crash, the likelihood is that their home will always retain a significant amount of equity. Now, this is great for everybody. If you think about this, it does mean that the homeowner has to have more equity up front, or they have to have a bigger down payment up front if they're buying a new home. But long term, what this means is that they have more flexibility and more stability. If they have to relocate in 10 years, if they have to go into a care facility in 30 years, the home is going to retain enough equity in it that it provides more options for them and for their family to either refinance that home into a regular mortgage and pull more money out, or to sell the home and have equity left over to be able to cover some of those end of life expenses. And so truly this is a good thing. This is a good thing for everybody involved. And so if you or somebody you know has considered a reverse mortgage, you didn't like some of the old features of the old reverse mortgage, you need to learn about the new features of the new reverse mortgage, because it truly is a great product. And as I say in the article, when I retire in 30 years, a reverse mortgage will be the mortgage that my generation uses to retire. They will become as common as a 401k, an annuity, and a pension. It'll just be the mortgage that retirees do when I get to that point. And so if you have questions, give us a call. We're at 435-359-9000, heritagereversemortgage.com, and we'll talk to you soon. Bye.